Good morning to our friends out west, and good afternoon to our partners here on the East Coast. We welcome you to a little update on where are we in the industry, looking through a lens of a multi-carrier solution. So at Life Brokerage, we are a provider of product and underwriting for 30 insurance companies. So what we do get as a perspective from 30 different distribution partners. And what we'd like to share with you today is a quick state of the union. What is the impact of rising interest rates? Where are we with guarantees? Share with you some product and sales niches, and then describe where are our biggest cases coming from. In this unstable, turbulent time, who is selling what, and what is driving the largest premium cases. So, quick state of the union. I like to start meetings out with these statistics. So, 1 out of every 6 U.S. long-term savings dollars is invested in cash value life insurance or annuities. We pay out over $2.1 billion a day through either income payments or death benefit. And we put $20 trillion of financial protection in force. And we still have a lot to do. There's about a $12 trillion protection gap. So where are we coming from? We're coming from a year where premium growth is up 18%. Policy sales growth was flat. But in 2020 and 2021, policy sales growth were up, right? We went through a global pandemic. So the life insurance industry, in our opinion, is coming out of a recession of its own. Long-term persistent interest rates really took a toll on the life insurance marketplace. And I'm going to show you a picture of the cycle of carriers and repricing and entering the market and premium restrictions, which I think will help make some sense to you. Changes in the rear view in 2022, COVID restricted underwriting is pretty much finished. Just about every major carrier has lifted any COVID restrictions that were imposed since March of 2020. Premium caps and restrictions have been lifted. I'm going to get into that in a minute. 100% remote working, and that's at the carrier level. So if you've noticed, it's a little more difficult to get things done. It's because carriers were challenged with 100% remote workforce. And we took on revised pricing under Section 7702, particularly in the accumulation market. Ongoing changes. So we're still decentralized at the home office level. So, if you're working with carriers who are well priced, you're probably experiencing processing delays and inefficiencies. We also face these antiquated systems where in-force policy service has been challenging. Now, carriers are making pretty significant capital investments into their in-force policy service models, but we are still facing some challenges. Automated insuring platforms. So what that means is, how are we doing with these accelerated platforms, this accelerated underwriting, these instant decisions? So, we're still working through those. I think it's sometimes frustrating that the technology is there, but the clients just can't get through the process for one reason or another. And a change, which I think is a good change, is that there's a further reduction to paper applications. The industry has been embracing e-apps. I think we're doing a good job at that, certainly a better job at e-apps than we are the accelerated underwriting process. And in due time, I think they both will improve. If anyone's in the index market, it's not just an S&P cap and floor anymore. Everyone has a low volatility strategy. So if you're in that space, you need to get acquainted with how it works and be able to translate that to a consumer, which is sometimes difficult. What hasn't changed is the tax law that pertains to life insurance. We have 5 internal revenue tax codes that put the power of life insurance to work. I'll send this out. I mean, these 5 tax codes really embrace what we do for a living and the story that we tell. So let me get into the impact of rising interest rates. And this goes for rising interest rates and declining interest rates. So what does that mean? When interest rates decline, right? Think about the COVID times. The first thing carriers will do before they reprice is restrict how much premium you can give them, right? We're going to slow things down. And if that doesn't work and they're still getting too much premium for the interest rate environment that we're in, they'll do a repricing. We've gone through a dozen repricing since 2019, at least. And if pricing doesn't work, they'll eventually just leave the market, right? And this is this big circular cycle. Now, as we see interest rates increase, we see premium restrictions being lifted. So we're allowed to give carriers a little more premium. What we think and what we believe is coming is a reprice. I think products will become more cost efficient, and hopefully we're going to see some new players enter the market because the product line is profitable again. So again, I think we've been in this 8 to 9 year recession in the life insurance industry, and as interest rates have ticked up a bit, it's providing us some relief. So that's on the positive. The negatives, right? Where are the areas of concern? Variable loans on insurance policies are problematic, right? They're hitting 6, sometimes 7%. So anyone using this either BY-owned banker strategy or debt consolidation, or have a lot of stress, greater than 50% of loan to value on their policies, are going to experience some pain. Client borrowing rates, and that goes for private loans and commercial loans, premium finance rates have increased. The life settlement market, valuations have decreased. When capital is being pushed out at 1%, now your hurdle rate is 8%, right? In the marketplace. When capital is being pushed out at 6%, your hurdle rate turns to 12. So life settlement companies are offering less for policies, right? It's just simple math. Areas of opportunity. Annuity rates have annuity and SPIA payouts have increased. So the old life only to life insurance, right? The SPIA arbitrage is starting to rear its head again in a good way, where a 75-year-old can capture a 5% yield after the annuity payout, pays their taxes, and funds a life insurance policy. Interesting strategy, tried and true. Just what's old is new again. We're seeing index caps increasing. Some mainstream carriers have announced increase index caps. And guaranteed universal life, we haven't seen this happen yet, but we believe it could get more cost efficient and create some replacement opportunities for policies that were sold over the last 7 or 8 years in lower interest rate environment. Just a quick example of where annuity rates are gone. We're finally over the 5% yield in a 5-year non-New York product. We haven't quite gotten there in New York yet, but New York is catching up. And similar to the difference between a 2-year treasury and a 10-year treasury, there's not much of a spread between the 3-year and the 7-year, or the 3-year and the 5-year. So, it makes sense to kind of stay short and see where things are going. We're also seeing private equity and interest rate volatility create some opportunities in our industry. And the emergence of private equity, is not a new thing. It's been a 36, 48 month time frame where private equity has driven a lot of capital into life insurance companies who are cash poor, and they like to get their hands on the capital reserves of an insurance company so they can turn those into higher yielding assets such as real estate and infrastructure, and at the same time manage operating costs. The insurance space is an attractive vehicle for private equity to deploy their capital. So, what we see is that, the tendency is if a private equity company moves into the insurance space, the dividend or the crediting rates tend to decline, right? Ratings dip a bit, and there's a couple classic examples. I'm not going to name any names, but let's just say that private equity has negatively impacted an insurance company or a block of business. Well, now creates opportunity for us to optimize and diversify. We've been using this strategy for decades. You run your in-force as you normally would, and you line it up against the original sales illustration, and then you run it as a reduced paid up. And the strategy here is to stop deploying good new money into the policy that is owned by private equity or a distressed company who isn't treating the policyholder properly, and to just pay up that particular contract and take the new money and redirect it elsewhere into a company that is. So this is a young professional basketball player bought a 10-pay whole life 3 years ago. Doesn't make a whole bunch of sense to keep deploying $100,000 premiums for the remainder 7-year schedule. We're going to take a reduced paid up from 5.2 million to 1.8 and redirect that 100,000 into a new whole life company or variable equity index, whatever you prefer, for the remaining 7 years. So it's a diversification strategy. Sometimes running 2 policies is more efficient than running 1. So I'm going to touch on real quickly markets that are on fire, where we're seeing a ton of action. First and foremost is the business market. We run with a program called Select Reward. It's very simple. You need to hang on to your key people. You keep a corporate-owned policy. You set a term of employment, right? You stay with me 10 years. I'm going to fund this particular contract to the tune of X dollars over the next 10 years. And then I'm going to transfer it to you at the beginning of year 11. It's quite literally that simple. So it remains an asset on the books of the company. It gives the key person something to look forward to, a lighter form of a golden handcuff. The corporation or the business maintains total control, and it's been a very effective, simple way to stay competitive in this extremely competitive labor force, right? We're doing tons of business valuations, buy-sell reviews. Companies are embracing defined benefit plans again. The 412I space is more active, particularly using cash balance, being that fixed annuity rates and auxiliary funds have increased in yield. No one wanted to deploy a bunch of tax deductible contributions into a 412I with an annuity paying 1%. Right now we're at 3s and 4s and 5s, and it creates this stability. Combine that with 7702 efficient pricing in whole life, and it starts to look like a much better return. Tons of high cash value riders for liquidity, up to 100% guaranteed for 10 years. C Corp split dollar, right? It's better to lend dollars out when you're in a lower corporate bracket than you are individually. And we're also seeing some asset-based long-term care in a C Corp. I will tell you that accumulation sales, and this is really neat, accumulation sales have been better than ever, particularly in our practice, up 35%. I can tell you that you can pick your flavor, but we're talking about whole life with New York Life, variable in a institutionally priced VUL that we can sell to an individual without a corporate endorsement, which is really neat. And on the IUL, we're using a Securian Nationwide product, typically through a Nexus. And what we're talking about is asset location, right? We always talk about asset allocation, where you need to invest in different asset classes to reduce your investment risk, but no one talks about the location of that asset, right? That's investing in different tax locations to reduce your tax liability. You have ordinary assets up to 37%, capital gains assets up to 20%, and tax-free assets in a 0% tax bracket. So it's an interesting story. I highly encourage you to take a look at some of the material we have. And we tell this story where the customer has a choice. You either pay fees, expenses, and taxes, or you pay fees, expenses, and COIs. And it's quite literally that simple. If the COIs are too high, you just don't do it. So you're targeting younger, healthier applicants in this strategy. We also have modeled through our friends at Insmark, what is this corporately institutionally priced VUL look like in comparison to an equity asset? And because you are able to create such higher values, the crossover point is much sooner. And then as we create income streams from this particular product line using the same exact assumptions as an equity alternative, the life insurance is far more sustainable. And we have a second page to this that will show the difference in cost of insurance, right? Just further elaborates on the fees and expenses and taxes of an equity portfolio versus the fees, expenses, and COIs of a life insurance COLI type product. So we're not saying one is better than the other. We're saying you should have both, right? The allocation story. Foreign nationals, this market is as open as we've ever seen. We're writing applicants from the West Bank and South America, and there's some international exams being allowed. And what the carriers have really done well, they've allowed us to use a power of attorney form where solicitation needs to take place in the United States, but delivery does as well. So it's more difficult to get a foreign national to the US in a timely fashion for both solicitation and delivery, because we don't know how long the underwriting process will take. But with the use of a power of attorney form, someone else in the States could sign and accept delivery on their behalf. So you only need one visit from the foreign national, and nexus requirements have gotten much less stringent. If I look at accelerated underwriting, we have a cheat sheet we can push out. What we're finding is that most companies have adopted some form of accelerated underwriting. New to the market is New York Life built a 10-pay product at $150,000 of premium. You're eligible. They're looking to turn this around in 48 hours. It's a brand new program, so we don't have a lot of data on it yet and the success rate, but they are very aggressive in trying to push this particular program. We're also looking at concierge underwriting platforms, meaning if you've had a physical, if you've had an executive physical, you can secure up to $50 million of coverage without an exam through Lincoln, John Hancock, and Principal. Really, really interesting program, particularly for executives. We talked about annuities already, but one thing I wanted to add is that there's a lifetime income benefit rider in New York now, which you'll want to take a look at for your New York clients. And long-term care is easier to qualify for on the annuity chassis than it is on the hybrid life and annuity chassis. So just be aware of that. What we're seeing again is related to that cycle and that picture we showed you is the guaranteed universal life market, and you can see that there are very few A+ rated companies that are available anymore with guarantees. And you'll see because of this cycle, right, which further describes companies leaving the market, is you'll see a lot of 2021s and 2022s in this space, right? Your Banners, your Lincolns, your Principals, your Prudentials, your Symetras, right? These are companies that are known for GUL that have left because of persistently low interest rates. So we hope as interest rates stay higher and continue to rise, that some of these companies will come back into the mix. Now, what they've done is just created some type of life expectancy type product where you have guarantees to age 85 or 90 to give them some relief and reserving. Again, I mentioned the S&P 500 index options. So virtually every major carrier, if you're in the IUL space, has partnered with an investment bank and created some type of asset diversification or volatility control index. AIG hooked up with Morgan Stanley, Hancock's with Barclays, National Life with Credit Suisse. So you need to get familiar with how these work and identify which ones actually do work versus the ones where you have to just sit and take it. Right. When you see the allocation, the constant allocation of say 50% S&P, 30% fixed income, right? Maybe you don't want to sit and take the fixed income for so long, right? Maybe you don't want to have that inflexibility of being in that. So you really need to understand where these indices are going and how they work. The variable world has gotten increasingly competitive, particularly on the guaranteed no lapse. There's a different actuarial guideline to fund reserves. So you'll see that there's 4 major companies in this space. So if you're looking for lifetime guarantees, this is still an attractive product line, particularly on short pays. Interestingly enough, though, the learning experience, as the mutual fund performance decreases, the life insurance carriers have a higher net amount at risk, which requires them to move more capital into reserve. So, you may see some tightening on the pricing of these VULs with lifetime guarantees. And there are some guaranteed survivorship options that are still available to us as well. Prudential being the big player in this space. So I'm going to get into some product niches real quick, and then we're going to dive into like where the biggest case is coming from. So as far as product niches, there's still a real niche-y product in the ART space. If you have a short-term need, or you have a policy in force that has a shorter duration remaining, like if you bought a 10-year term policy 5 years ago and you only have 5 years remaining on your term policy, it's a great way to feather in some real low cost initial premiums on this particular product. It also gives you the ability to convert in the first 36 months to level 20 or 30. So yeah, you can convert term to term or a GUL product. So definitely interesting to take a look through your book of business and find some of these opportunities. Additionally, AIG has a custom term. You can customize the term period anywhere from 15 to 35 years. So if you sold a 20-year term policy a year ago and there's 19 years remaining, yeah, you can buy in a 19-year term policy from AIG, sometimes a little more cost efficiently and with better conversion options, right? We said how a lot of companies have left the market, particularly the GUL market, and just giving you like crap to convert to. So, in those instances, tie goes to the company who provides the best conversion opportunities. This is a little fuzzy, but what I'm showing you here is a guaranteed lifetime income rider on a cash value life insurance accumulation based product. This is an IUL. Some of the knock on IUL is that the carrier controls all the variables. They can maneuver cost of insurance and caps and completely control your destiny. But in this particular instance, there's truly a guaranteed tax-free lifetime income rider associated with this particular policy. So if you're creating streams of income, or you practice LEAP or wealth building cornerstone, or trying to build a private pension design, this is a great way to do it. We've even used this product in that business market setting, that select reward, where, hey, you stay with us 10 years, or we're going to guarantee you $51,000 of guaranteed tax-free lifetime income the rest of your life. And if the product does what we expect it to, that's going to be a $75,000 guaranteed tax-free income for the rest of your life. So pretty cool concept there. Guaranteed policies, like, don't fall asleep on them. If you look and you've written guaranteed ULs, look to see if you can optimize them. In this particular instance, this client had $3 million of death benefit and a $21,000 premium. And if you may find some hidden value in the shadow account here. I can reduce this face amount in half, call it, and instead of the premium decreasing by half, it actually goes away completely. So, I crashed that $3 million death benefit to 1.4, and the $21,000 premium goes to 0. So I go out and buy the net amount at risk for $15,000. It's a more efficient design, 2-policy approach versus a 1-policy approach. I think you can do the same in the whole life strategy. Flexibility with graded premium designs. This is an interesting concept, right? You don't necessarily have to pay level premiums. these programs, these policies are actually called flexible premium universal life. So you can find some efficiencies in here where you don't have to actually pay a level premium. You can pull back on that, retain the capital, go out and invest in different opportunities, and then create a side fund to utilize for the catch-up premiums thereafter. Here's a graded design where we pay $305,000 a year. Tax-free IRR at age 85 is 19.24%, which is a pretty astounding rate of return. PDA accounts. So insurance companies are now looking to take in your premium dollars, where we had premium restrictions where they were looking to slow down by the deployment of premium because they didn't know where to put it in those lower interest rates. Now that interest rates have upticked, they're willing to hold your money in escrow and deploy those premiums over a 10-pay design or 7-pay design or 5-pay design. So premium deposit accounts are creating some interesting arbitrage. I'm going to dive into, for the last segment of the call, we're going to spend about 10 minutes here. Where are the biggest cases coming from? And then we'll open it up to some questions. I'll try to answer questions as we go through the presentation. So where are the biggest cases coming from? First and foremost, I think just creating awareness that today's tax law is changing or sunsetting at the end of 2025. So a $30 million taxable estate has a $2.4 million tax liability if simultaneous death occurred today in column 7 here, right? If I project that $30 million estate out to 2026, when the law sunsets, it's $30 million is worth $32 million. And that tax liability increases from 2.4 million to 7.8 million, which is a pretty big difference, right? It's 8% of your net worth versus 24% of your net worth. So, I would suggest that if you plan on living, 4 more years, you're going to want to do some planning. And, I'll get into in the next slide, you should plan now before it's too late, right? And if I project this out to life expectancy and assume the exemption increased also by 2%, that's a $10 million tax liability. So, Build Better Back tried to take out the higher exemption limit and grantor trusts and grantor retained annuity trusts and installment sales and family limited partnerships and mega qualified plans or mega IRAs. And I will tell you that the anti-clawback regulations are very favorable. You're allowed to make these gifts right now, and you're not going to get your hand slapped, come 2026 when the law reverts back. So, every estate planning attorney that we speak to or work with is encouraging similar behavior. Like, let's take a run at this now before it's too late. And just very simply, we're just providing the economics here on the impact of an intentionally defective grantor trust. So on the left side is when the trust pays the capital growth taxes. On the right side is when the grantor pays the capital growth gains in this particular asset. And you'll see 20 years out, it's a difference of $10 million. So it's a huge advantage to be able to draft an intentionally defective grantor trust and have the grantor be responsible for the tax liability on the growth of that asset. So 10 million turns to 25 in 2 decades. Without that feature, 10 million turns to 35 million with that feature. So it's really powerful stuff. Now you're talking about gifts and the tax treatment of trusts, right? Column 2 is a wonderful way to go out and buy some life insurance here, and you can always make an argument of why a portion or all of that gift should be used to buy life insurance. Your high net worth clients. So your high net worth client is somewhere between 5 and 15 million plus. We feel like the most underutilized code in life insurance is section 7872. A lot of our biggest cases this year, 4 of them or multiple seven figures involve the use of 7872, whereby party A could advance premium for a set number of years on a life insurance policy owned by party B, right? There's just two parties, which is, in fancy terms, split dollar, right? This is not just for the super rich and famous. This is nothing more than an intrafamily loan, right? And an intrafamily loan allows family members to borrow money from one another at a special rate, a rate that the IRS publishes, which is still below market, right? When 30-year mortgages hit, 6% plus, and the IRS intrafamily loan rate is 3.4, well, why wouldn't I borrow money from wealthy Aunt Susie versus Wells Fargo, right? At 6%, when wealthy Aunt Susie can let me borrow money at 3.4. So as long as it's structured properly so that the loan is not considered a gift, and you have a very basic written promissory note, and you charge interest, this is a technique that has been used for decades and decades and decades, right? This particular strategy, what I'm going to call the new wealth transfer, reaches a much larger wealth segment in the United States than the old-fashioned, right, quote unquote, split dollar. This is much more practical. So the new wealth transfer, in my opinion, creates solutions for liquidity, control, flexibility, chronic illness, right? A long-term care claim is the new estate tax for these particular wealth segments. And chronic illness is not just for old people or not just for the wheelchair bound, right? 130 million people live with chronic disease. And that number will grow to 170 million by 2025. So these people, you just can't see their disability because 96% of them are invisible. And if you look at what they are, they're heart disease and cancer, and chronic lung disease and Alzheimer's and diabetes. Right? 6 in 10 adults in the United States have a chronic disease. And a long-term care claim is devastating to an income plan, a legacy plan, an asset protection plan, right? So the new high net worth estate plan is involving life insurance, chronic illness planning, maintaining flexibility, control, and liquidity. And why we like to use private loans is that because gifts are forever. And when you're in that $5 to $15 million net worth, you don't want to give your assets away, right? If I lend it to my trust, it's nothing more than an intrafamily loan. I can get it back if I ever needed to. And AFR rates are lower than bank rates. So if I have an ILIT, I can add a spouse or beneficiary access provision. I'm going to create estate liquidity through the life insurance death benefit. Any assets that are in the trust are creditor protected from divorce or grantor or beneficiaries, really all parties. I'm still going to avoid probate, and I'm still going to have all the benefits of a trust to employ a professional money manager for the beneficiaries. So if you combine an ILIT and long-term care, structure it the right way with a 7872 loan, kind of cover all aspects of the plan. So what you're seeing here, and again, I can push this out in columns 1 through 6, is a $2 million loan to trust, right? This is Lisa G. She's a 51-year-old female. She has $2 million. Again, not an ultra high net worth. You're talking about a high net worth individual. The rate today is 3.43%. So if Lisa lends $2 million to her trust, she owes herself, right, per se, $68,000 in year 1. She has three annual exclusions, so that covers 48,000 of the 68,000. So the balance of the cumulative loan is accruing in column 2, right? If I use a premium deposit account in columns 7 through 10, right, we talked about this earlier in the show. I can invest that 2%, that $2 million at 4.75%. And the insurance company will deploy $437,000 of premium over the next 5 years. So this is a 5-pay strategy. So if everything goes as planned, everything will pass to the family in columns 11 through 13. She has $17 million of premium deposit and cash value. So there's your liquidity and your control. You have $7 million of death benefit. And even after the $2 million goes back to her estate, $5 million passes along to the family, creditor protected and income and estate tax free. Now, it also gives her the ability that if she makes poor choices or circumstances change, that she can actually take back, because we're using a cash value driven policy, she can actually take back or amortize that note back to herself based on what the life insurance policy can support by way of distributions. So here's an example. Lisa makes terrible decisions. She's 71 years old and she needs cash. Remember, the original loan at 3.43%, the terms were set by the IRS minimums. No one says you can't renegotiate those terms. So if I determine that the insurance policy can substantiate $300,000 of tax-free distributions from age 71 to 90 in column 17, right? And I know that the cumulative loan balance in year 20 is 2.183 million. I take my HP 12C calculator and I figure out what is the interest rate I must charge myself to amortize down $2.1 million of loan balance, which I owe myself, using a $300,000 payment over 20 years. And that interest rate is 12.63. That's the output I get. It's nothing more than a present value interest rate calc. So I modify the promissory note from 3.43% to 12.63. I'm certainly entitled to pay not just interest, but principal and interest. And I amortize that note down over a 20-year period. So in this particular instance, we had total flexibility and control. We had a chronic illness benefit in column 18 to the tune of $20,000 per month if you got sick along the way. You had tax-free and creditor-protected death benefit if death occurred prematurely. And you have this ripcord where you're able to amortize back the note to yourself if circumstances change and you run out of cash flow. So I'm happy to take a deeper dive into this particular subject matter offline, but they're the highlights of the 7872 quote unquote new wealth transfer that involves creditor protection, chronic illness, and maintain liquidity and control. So let's spend just a couple minutes on the ultra high net worth. Similarly to what we just showed for Lisa G, this particular this particular couple actually have blown out their entire exemption and they wanted to transfer more. They still had a huge tax liability. They had a $50 million liquidity event. And what we suggested was that they're going to recognize this tax anyway. So $50 million at 37% bracket leaves you in column 3 with $31.5 million. We made a one-time 7872 loan, deployed this, we spend down the $31.5 million to the tune of $3.6 million over a 10-pay basis. And what we're showing here is column 8. Column 7 is your cumulative loan. Column 8 is the interest rate you must charge yourself. Column 10 is the annual interest due. And the objective here is that if you can grow a policy, right? This is a survivorship whole life policy. If you can grow a policy equal to or faster than the AFR note, you can accrue the AFR note forever. And you'll see in column 7, that note gets pretty large. But you'll also see in column 12 that the death benefit does also. And if your death benefit and your cash value are growing in tandem with or faster than the AFR note, you're going to create wealth without ever recognizing a gift tax. Remember, they utilize their entire exemption, their annual exclusions are accounted for, but they still have a problem. So why we coined this the unlimited gift is simply because you're playing the arbitrage of a abnormally low AFR loan rate, even in today's world, in this rising interest rate environment, and an insurance policy that is going to grow in tandem with or faster than the AFR rate. Going to jump into a spirited discussion about commercial financing, right? This is a huge topic. It's got recent publicity in the Wall Street Journal. It's certainly a well covered subject in our business. So, here we are, financing all years and servicing interest for 25 years. So there's a 7-pay, again, whole life contract, assuming bank loan rates in column 3 are 7% today. They creep up to 8, they go back down to 7, and then they stabilize at 6%. You have some collateral in the far right column 9. And what you're going to see is that if you service the debt for 25 years, you still have a viable strategy, provided your retained capital is doing well, right? Which is the whole point of this. Whether you own a bakery, a winery, an insurance agency, buildings in Midtown Manhattan, whatever it is that you're doing, you don't want to stop or impede on the compounding growth of that particular asset. And that retained capital has to continue to grow for you. Otherwise, premium financing just doesn't make sense. But just a different twist on this, we actually had a customer this week say, you know what, I'd like to miss these 7 and 8% rates right here. I'd like to miss, grab my drawing tool here. I'd like to miss these couple years of 7 and 8% in years 1 and 2, and I'm going to fund the premium on my own. And once I see that interest rates turn, then I'll begin using the premium finance strategy and arbitraging my assets. But I'd like to get out ahead of this, eliminate all the collateral issues, and give this transaction a running start, which turned out to be a completely different looking model by deploying 1 or 2 of the first initial premiums. It's a really great strategy. I'd also say that we're utilizing placeholders as a term rider. So in this particular product, we're able to add a term rider equal to 4 times the initial base policy amount. So what you're seeing here is a $5 million base policy with a $20 million term rider, which is convertible for the first 10 years. So I can pay the base premium out of pocket, which is $194,000, and add a $3,300 $20 million term rider, which gives me the contractual right to convert, once interest rates stabilize, all or some of the $20 million term rider, which is also a placeholder and a really viable strategy in today's market. We're also seeing what we call reverse financing, where the banking community loves the security of whole life, and you're getting preferential borrowing rates if you're pledging your whole life contract as collateral. So what we're seeing here is the applicant actually pays the full premium and intends to pay the full premium all years, and then takes that particular policy to their local bank or a bank that provides a whole life line of credit program and reverse finances up to 90% of the cash value. So in this particular instance, you control the variables much, much better. Rather than financing the premium going in, you're financing the cash value using the policy as collateral. We look at comparing commercial financing versus a graded premium design, which we showed earlier, right? Where you don't have to necessarily pay the level premium. You can just very simply pay the minimum premium that the insurance company asks you to. And we will run a comparison based on your projected out-of-pocket in a commercial financing strategy versus deploying that to a graded premium design. And sometimes, and the makeup of each client is different, sometimes the graded strategy comes out significantly better than the commercially financed program. So it's not every time. It has to be run, it has to be considered. And in this market today with 6-7% bank loans and probably heading upwards over the next 18 months, it's definitely an analysis you're going to want to consider. So we've hit our 45-minute mark. We had tremendous participation today. I don't see any open questions. I've done a pretty good job of answering them along the way. I want to thank you for joining. This was recorded. You will get a recording. We're set to do another webinar in November on tax deductible life insurance through defined benefit plans as a year-end strategy for tax planning in mid-November. So at this time, our meeting will adjourn, and I thank you for your attendance, and be well, everyone.